Hey everyone, this is Taylor, and we're going to talk about core trading setups, the why and the how. So there's 5 components of a successful trade. You have the setup, the strategy, the entry, the stop or your exit, and then you have your profit target. And taking a trade without a good understanding of each of those components, it's kind of like driving with a blindfold on. Never really a good idea. So your setup is a reason for taking the trade. We found a moment in time where we have edge to either call for a move higher or call for a move lower. If we don't have a setup that offers some sort of edge, then we don't have a trade. And then your trading strategy, that's our methodology for buying and selling options, stocks, futures, really any market you can think of. And then a couple examples here of call it traditional strategies. You have trend following, reversion to the mean, breakout trading, and then day trading. And then as far as entries go, entries are really important. It's one thing to have a good setup. If you're not trading that good setup with good entries, you're not going to have as much success as you potentially could if you try to take those entries near key inflection points. So for me and my trading plan, I'm always trying to take my entries as close to that 21 period EMA as possible. 21 period exponential moving average. When I take my entries there in that 21 EMA, it allows me to trade my go-to setups while working a really good risk versus reward. And then where that 21 EMA also plays a role is in my exits. So I think you also want to anchor to these key inflection points, key moving averages for your entries and for your exits. Again, the goal is to trade a high quality setup while at the same time making sure we're working a good risk versus reward. So for my trades, if I'm getting long, I want to get long as close to that 21 EMA as possible. And then at any point, if the price closes below that 21 EMA, that's where I would stop out and take the trade off. Right? And that's how I work a really good risk versus reward. So a good example here would be the daily chart of Google. I've got my daily squeeze. I want to buy that right above that 21 EMA. And then from there, if the stock closes below that 21, I'm going to take the trade off. If the trade works, what I'm looking for is a push into the 2.5 ATR Keltner channel. Keltner channel is measuring average true range moves above that 21 EMA. So my target when I get long is 2.5 average true range moves above that 21 EMA. So I buy it above the 21. My risk is a move below the 21. My reward is a push all the way up there towards 2.5 ATR. So here's an example of a trade where everything came together. I had my squeeze, the MACD was bullish, and most importantly, I locked in a good entry. So daily squeeze for Zoom. We bought it right above that 21. And then about a week later, we caught the push there into our target. 2.5 average true range moves above that 21 EMA. And that's a trade that I look to rinse and repeat, pretty much every week and every day. The classic squeeze trade. So these are the kinds of things you want to put into your trading plan. What kind of setup do I want to trade? Am I a breakout trader? Do I want to have a squeeze first focus? Do I want to buy pullbacks? Do I want to short rallies? You want your setup to be built around a few key things. Something that gives you edge, and then something that allows you to dictate a good risk versus reward. Where's your exit? Where is your line in the sand? And then where's your profit target? Before you pull the trigger on any trade, these are things we should know in advance. Is it a good setup? Do I have a good entry? And if the trade works, do I have a good reward? And then one thing that I think is really helpful, especially for newer traders, put together a trading plan and then trade it on a paper account or a simulated account. I'm a fan of trying to get, say, 25 trades under your belt. So trade the same setup for 25 trades in a row. And then from there, you've got proof of concept. If you have a good win rate, If your wins are bigger than your losses, then you can take that trading plan and apply it to a live account. And then we have to consider, when is a trade gone sour? When is a trade considered bad? For me, a trade is considered bad when it no longer fits the game plan. To keep it nice and simple, when my reasons for taking the trade to begin with have disappeared, whatever those reasons might be, there was a squeeze, there was a buy signal, price was above the 21 EMA, when my reasons for taking the trade have disappeared, it's no longer a valid setup. When it's no longer a valid setup, I no longer have edge, and from there I've got to close that trade and then move on to the next one. So one more look here at the 5 components of a successful trade: the setup, the strategy, the entry, the exit, and your profit target. Focus on each of those 5 components, and then from there you're actually building a foundation from which you can continue to build upon. And then keep in mind, not all losing trades are bad trades. All right, losing trades are part of the game. The key is you want to trade good setups. Right, trading good setups will put you in a ballpark where more often than not your trades will work. Then the key is with the trades that don't work, just make sure those losses are smaller than the winning trades. And for all of us as traders, that's kind of the holy grail. You have a strategy, you have a setup where you win more often than you lose, and when you win, you make a lot more than you lose when you're wrong. Simple stuff, guys, but your foundation will be built around these simple things. Okay, swing trading with multi-time frame analysis. Personally, my favorite. So things that we have to understand, guys, when it comes to timing. Timing plays a big role in a couple different ways. One, how quickly are we looking for this move to unfold? If we're trading a setup on a time frame where we think the move might happen today, that's going to determine our expiration date and our strike selection for our options trades. If we have a setup we think might last for 4 or 5 weeks, we're going to give that trade more time and potentially structure that trade a little bit different than something like a 5-minute or a 15-minute squeeze. So for longer term charts, you have the monthly time frame, the weekly time frame, and the daily time frame. And of course, on your monthly chart, every bar is 1 month of price action. So you'll have a January bar, a February bar, etc., etc. The weekly chart, every candle is 1 week of price action. So every Monday morning you get a brand new weekly bar, and then the same thing for the daily chart. And then for your shorter term time frames, you have the 4-hour, the 1-hour, the 30-minute, the 15-minute, and the 5-minute. So what does it mean when we say what time frame what time frame is a chart on? Are we taking trades based off the 30-minute chart, the daily chart, the 195-minute chart? Shorter time frame chart, such as a 5-minute, a 15-minute chart, you're typically going to look for trades that last for 45 minutes to maybe 2 hours. Day trading, 0 day till expiration options, that kind of thing. Whereas a larger time frame chart, your weekly chart, your daily charts, typically those are going to be setups for trades that last anywhere from a few days to maybe a week and change. So swing trading versus day trading. Personally, for my swing trades, I work off of the monthly, the weekly, the daily, the 4-hour, and the hourly charts. If I'm a bit more in day trade mode, I like to work from the 1-hour, the 30-minute, all the way down to the 5-minute or the 1-minute. So we got our swing trading time frames, and then we have our day trading time frames. And as far as a couple timing tips, whether I'm doing a day trade or a swing trade, when it comes to options trading, you want to give yourself the gift of time. You might find a setup that you think should hit the target in 2 days. If you buy the options that expire in 2 days, and it actually takes that setup 3 or 4 days to hit your target, you're not going to be there to catch that move. Right? You call for the correct direction, it eventually hit your target, but you cut it too short as far as the options go. And this is especially true, guys, when we're buying options. The shorter dated the option is, the more you're fighting that premium decay, that theta. So whether it be a swing trade or a day trade, a couple things we have to take into consideration for our options. What expiration series will I use? Am I looking for a trade with 5 days till expiration, 30 days, or 60 days? And then I think you also want to take a look at the expected move. If I buy calls on, say, John Deere, and I buy them for the December 18th expiration, so I'm giving my trade about 30 days till expiration to work. If I'm looking for a $50 move, and the expected move is only about $22, unless I have a bunch of squeezes, there's not that great of a chance I'm going to see a $50 move. That's 2 times the expected move. So that can be helpful, and then of course your strike selection. If I want to get long John Deere for December 18th expiration, am I buying out the money calls? Am I buying the pricier, but a little bit more well-behaved in the money calls? All kinds of things you have to take into consideration. And then for my strategy, the time frames that I use, again, for swing trades, weekly charts, 2-day charts, 3-day charts, daily charts. And then for day trades, I drill down to sometimes the 4-hour and the 2-hour. It really does tend to be the 1 hour, the 30-minute, the 15, and the 5 for those day trades. So for example, say I'm trading a daily squeeze. My go-to trade for a daily squeeze would be the options that expire in about 30 days. And then I'm a big fan of just buying the the in-the-money calls if I want to get long, or the in-the-money puts if I want to get short. So somewhere around that Delta 70. Delta 70 calls, Delta 70 puts. And then my favorite setup would be a nested squeeze, meaning we have a daily squeeze printing inside of a bigger weekly squeeze. Those are definitely my favorite. And it's important to understand, guys, that varying the time frame, there's a difference between varying the time frame of the chart setups versus varying the time frame of the trades. Meaning, generally, if you have, say, a setup on the daily chart, you do want to give yourself about 30 days till expiration. If you have a setup on a 4-hour chart or an hourly chart, you might want to go for a little bit less. We're trying to strike a happy balance between I'm buying the options close enough to expiration that if I do catch the move I'm looking for, I'm going to get a really good bang for my buck, while at the same time I'm not too close to expiration that if the stock trades sideways for a few days, I'm getting torn apart by that premium decay. So always trying to strike a happy balance. And again, I think you can strike that happy balance by leaning a little bit more into the gift of time. So my core setup is the Big 3 squeeze. And the whole goal of the Big 3 squeeze is trying to find those moments in time where stocks are setting up for a very explosive move. But I'm trying to find them before that explosive move unfolds. So that's where the timing plays a big role. And part of my strategy is looking from the ground up. For example, if I want to take a trade off the hourly chart, so I've got a really nice hourly squeeze, I'm going to look for multi-timeframe confirmation. If I think, for example, the hourly squeeze is going to fire long, I want to make sure I have the alignment, meaning I want to make sure my 30-minute, my 15-minute, my 5-minute, I have to make sure that all the time frames inside of that hourly squeeze, I want them to be lined up for a push higher as well. Right? That's my confirmation, that's my trigger to then go trade that hourly squeeze. More importantly, watching things from the ground up, it can offer a bit of a warning sign. If I buy calls on, say, Apple. Apple has an hourly squeeze. I buy calls thinking the squeeze will fire to the upside. If the 5-minute and the 15-minute charts begin to break down, and the structure is busted, momentum shifts, they get a sell signal, that's kind of my early heads up that things are starting to sour from the ground up, and potentially that could cause problems for that hourly squeeze. So for my day trades, the whole foundation is built on the daily chart. The daily chart sets the stage for what could be a big move. From there, I'm looking for my alignment on all the lower time frames inside of that daily squeeze. So Google here's a beautiful example where we have the daily squeeze. We have the green arrow on the squeeze, so that's our big 3 buy signal. Now I know the stage is set. I have a squeeze, and during that compression phase, the indicator is printing a buy signal. So long as that's the case, there's a really good chance here that daily squeeze wants to fire to the upside. All that does, though, is set the stage. From there, I need that multi-timeframe alignment. So notice up here on the big 3 labels, inside of that daily squeeze, the 4-hour chart, the 2-hour, the 1-hour, and the 5-minute, they all had a buy signal as well. So now 4 of my lower time frames inside of my daily squeeze, they confirm what I'm looking for. Path of least resistance for the 5-minute, 1-hour, 2-hour, 4-hour charts is to the upside. As long as that's the case, that can light the fuse for that squeeze to fire to the upside. Now imagine instead that that daily chart wasn't as bullish. A little bit more neutral, not quite an A+ setup. From there you can look down to your lower time frames. My daily chart is neutral, but if my 4-hour, 2-hour, 1-hour, 30-minute charts have a buy signal, that could be my early entry. If I'm trying to trade a 15-minute squeeze, but it's a little bit neutral, but then I see a buy signal on the 5-minute, the 3-minute, the 2-minute, that could be my early entry. So from there I could take maybe half my position size, and then when my anchor time frame gets the official buy signal, then I can put on the rest of that trade. Right? Different things that we can do when we're analyzing stuff from the ground up. Google is what I would call an A+ setup. If I'm going to get long, it has to fit this template. Right? The template being the stage is set on my anchor time frame. I have confirmation for a move higher across my lower time frames. If both of these things do not come together, then I don't have an A+ trade. I might have a good setup. I don't have my triggers that allow me to call for direction pretty much right here and right now. Alright, so let's talk about the squeeze setup. The squeeze is our primary trading tool here at Simpler, so understanding how to read the squeeze, recognize the squeeze, and then ultimately trade the squeeze is a big part of everything that we do. And the squeeze helps us find these moments in time where a stock it's catching its breath and it's gearing up for that next explosive move, or what you could refer to in the options market as a bigger than expected move. Now the power of that is that 80% of the time, the market's really not doing too much. We're just kind of trading back and forth in a choppy range. It's the other 20% of the time that you're getting those big, concentrated, explosive moves. So the squeeze allows us to take our entries, both long and short, before those explosive moves unfold. And that's where you have the 2 phases of the squeeze, the compression and then the expansion. The compression is the buildup of energy, and the expansion is the release of energy. So our goal is to build our positions during the compression, and then we look to take our profits during the expansion. So think of this very much like a coiled spring. When a stock is in a squeeze, whether it be on a weekly chart, a daily chart, a 30-minute chart, the stock is basically a coiled spring. We want to find that coiled spring before that big pop. So a couple basics of the squeeze indicator. First thing we have here are the squeeze dots. So the red dot means that we are in a squeeze. The stock is going through that compression phase. When we get our green dot, that means the squeeze is fired. So we've gone from the compression phase to the expansion phase. And then you have the momentum histogram. If the bars on the histogram are light blue, that means momentum is bullish and rising. If the bars are dark blue, that means momentum is bullish but decreasing. If the bars are red, that means momentum is bearish and decreasing. Yellow bars means momentum is still bearish, but it is on the up and up. So you got the squeeze dots, and then you have your momentum histogram. So the squeeze rules. Red dot means we're in compression. At that point, I'm looking to get long or I'm looking to get short. When I start to get my green dots, meaning the squeeze is fired, that's when I'm thinking about taking profits. So for our bullish trades, we want to take entries during those, when we have the red dots, ideally with a bullish histogram. So for a put credit spread or maybe some calls, we're looking for a squeeze, and ideally the histogram is either light blue or at a minimum dark blue. For our bearish trades, we're looking for the histogram to work in our favor for a move lower. So we would get short during the red dot squeeze, ideally with the histogram being either red or yellow. So phase 1 is the buildup of energy. Google here on the 15-minute chart, right, you're going through that compression phase. And then phase 2 is the release of energy, the expansion. So Google prints a 15-minute squeeze right near that 21 EMA. Squeeze fires, and that's the push you would look to take your profits into. Amazon on the 4-hour chart. Compression at the 21 EMA. Expansion towards your profit target. Now to take it a step further, you want to combine the squeeze with, I think, additional criteria. So I only trade squeezes that fit my list of criteria. Whether it be for a long or whether it be for a short, momentum, structure, things have to line up in my favor for me to confidently call for direction out of that squeeze. And in my experience, if you can have a squeeze first focus, have a squeeze first focus, from there build some criteria, some momentum criteria, some structure criteria, some stacked DMAs criteria. If you can really fine tune the squeezes that you trade, in my experience, that can not only lead to a really good win rate, more importantly, it can lead to a good risk versus reward. If you find a squeeze with a really good chance of firing to the upside, and you take your entry nice and close to that 21 EMA, it's going to be a good risk versus reward trade. Vice versa for the shorts. Now, as far as time frames, where can we use the squeeze? And the beauty of it is you can use it on any time frame. If you're a swing trader, you might be looking for weekly or daily squeezes. If you're a day trader, you might be looking for 30-minute or 15-minute squeezes. Key thing to remember is once the squeeze fires, typically that momentum is going to last for about 8 to 10 bars. So if you have, say, a 5-minute chart, the move might last for about 40 minutes. If you have a 30-minute chart, or a 30-minute squeeze and the squeeze fires, it's typically going to last for about 6 to 8 30-minute bars, right, or 240 minutes. A daily squeeze you would look for 8 to 10 days, a weekly chart 8 to 10 weeks, and then a monthly chart you'd be looking for 8 to 10 months. So Apple on the 15, squeezes above the 21, histogram was positive, right, dark blue and light blue, squeeze fires to the upside. Weekly squeeze here on Goldman, squeezing under the 21, the histogram was negative, and then my indicator, the big 3 signals, I had sell signals. So that tells me my momentum, my structure, my moving average crosses, everything lined up for that squeeze to fire short. And again, you can look for the same thing here on a monthly chart. So going back to early 2020, big monthly squeeze for the QQQ. That squeeze firing to the upside gave us our uptrend. So the life cycle of the squeeze. All right, we are in a squeeze. When we find a squeeze, we have to figure out, is there a better chance it's going to fire long or is it going to fire short? So again, that's where your checklist of criteria comes into play. When the squeeze then fires, ideally we're in the trade before that happens. All right, that's our edge. That's what allows us to work a really good risk versus reward. So the day you wake up and the squeeze is fired, ideally you've already taken your position. And then by the time the squeeze runs out of momentum, ideally we've already taken off our profits at our extensions. So adding the squeeze to your chart, The squeeze is built into the thinkorswim platform, so you can find it by going to Studies, Add Study, then go to John Carter Studies, and then you'll see the TTM squeeze. And if you're not using TOS and you would like to try to squeeze on TradeStation before purchasing it, you can go to the TradeStation App Store and use it for a monthly fee. And then otherwise, guys, the squeeze can be purchased for TradingView and Infinity. And then there's also the Squeeze Pro. So the Squeeze Pro shows us different compressions of squeezes. You have the low compression squeeze, which is the black dot squeeze. The mid compression, which is the red dot. The low compression, which is the black dot. The mid compression squeeze, which is the red dot. And then you have the high compression squeeze, which is the orange dot. So you have 3 different settings, and these can give you an early warning that might not appear on the standard squeeze. Right, you can see that compression phase begin a little bit earlier. You can also spot those times where things are, we'll call it extra compressed. So putting it all together, you want to find a squeeze that fits all of your momentum and your structure criteria. Aim to build your positions near that 21 period EMA, 21 period exponential moving average, and then look to take your profits on the push towards that 2 to 3 ATR counter channel extension. So aim to take your profits about 2 to 3 average true range moves above that 21 EMA. And from there, you rinse and repeat. And the last thing to remember here is that stocks always come home. Home being that 21 EMA. So once the stock is trading up there at those extensions, 2 to 3 ATR above that 21, regardless of how strong it might look, now you've got this growing probability that sometime soon it's going to pull back. Like sometime soon, it's going to revert back to the mean. Therefore, it's really important for us to take profits before that reversion to the mean. Take profits into the strength when you're long. Take profits into the weakness when you're short. Okay, nested squeezes. Now, these can be very powerful. A stock has nested squeezes when multiple time frames are squeezing at the same time. And these just so happen to be my favorite setups. So for example, you have a daily squeeze printing inside of a 2-day squeeze, which is printing inside of a weekly squeeze. You have 2, 3, 4, sometimes 5 squeezes, all printing at the same time in the same stock. So a good example would be NVIDIA. NVIDIA had a 30-minute squeeze, and then nested inside of it was a squeeze on that 15-minute time frame. So what that can give you is that domino effect, where if the 15-minute squeeze fires to the upside, and then begins to release energy, from there it could trigger the 30-minute squeeze, which could obviously lead to a bigger move. Here's a good example of a nested squeeze on Netflix. You had a squeeze printing on the daily chart. That daily squeeze was nested inside of the weekly squeeze. When the squeeze on the daily chart fires, that triggers a push that eventually causes the weekly squeeze to fire as well. Domino effect. One squeeze leads to another, leads to another. Okay, my morning routine. So the first thing I do is wake up, eat a quick breakfast, and then I check the futures. Now, I get up pretty early, about 4:30 in the morning. But even that early in the morning, sometimes there's some A-plus squeezes on the ES or the NQ. And if I've got a good setup, I might take a trade before I head to the gym. And then the second thing I do is my early morning workout. I love lifting weights. I've been working out for, going on about 15 years now. And this just helps me get a nice start to my day. Get the blood flowing, get loose, get some of those positive endorphins going. From there, I'm ready to start the trading day. So the third part of my morning routine, post-workout, I am back at the desk and I'm getting ready for the open. I'll look at the big 3 signals in the futures. Are we leaning bullish? Are we leaning bearish? I'll make sure I got my watch list ready. My watch list of nothing but A-plus setups, of course. And then on most days, I'll jump onto the mic and do a pre-market prep session in the simpler rooms. Setting up our watch lists, which is a really big part of being prepared as a trader. So the daily big 3 routine. First thing I do is check the indices for the big 3 signals. Then I check the sectors for the big 3 signals. Then I'll check the signals on the market leaders. So your Apples, your Amazons, your Googles. And then the fourth and final step is to run the big 3 scans. So as goes the market, goes the stocks. Meaning if the S&Ps and the QQQ are very weak and they're rolling over, there's a pretty good chance that most stocks out there are going to do the same. So when I'm day trading or I'm swing trading, whether I'm getting long or short, I want my longs and my shorts to be in the rhythm with the market, right? To be in alignment with the overall move in the market. So checking my signals on the indices keeps me on the right side of the overall market move. And I'm a big fan of checking the signals in the futures. Pre-market heading into the open, if we have something like an hourly squeeze with hourly buy signals on the S&P futures, it's a pretty good heads up that, hey, if that squeeze fires long, the first 30 to 60 minutes of the session might lean a bit more bullish. You can see on Bitcoin here heading into the open, you had an hourly squeeze with an hourly sell signal. Offers a pretty good heads up that it might be a weaker day for Bitcoin. And then step 2, we check the signals on the sector ETFs. All right, that gives me a quick insight to the overall, call it health of the market. So you have XLK, which is big tech. You have SMH, the semiconductors. XLF is the financials. XLV is healthcare. XLE is energy, utilities, industrials, etc., etc. I'd like to check the big 3 signals on each of these to see who's bullish, who's bearish, and more importantly, is there an overall theme? Are most sectors bullish, or are most sectors bearish or neutral? And then from there, you have the market leaders. So these are your Apples, Amazons, Teslas, Googles, your Microsofts, your Nvidias of the world. The reason these stocks are so important is that they're very heavily weighted in both the S&P and the QQQ. Therefore, their direction tends to have a pretty big influence on the overall market. And then step 4 is I fire up my big 3 scans. The only thing I want to focus on and trade is my big 3 squeeze. So I fire up the scans and say I'm looking to get long. We're looking for bullish trades. What we're scanning for is an active big 3 squeeze, an active big 3 buy signal, and I got to make sure price is trading right within my buy zone. So in the next section here, we'll talk more about my big 3 signals. Okay, how to use the big 3 signals. And one thing I love about the indicator is that it's really simple, straightforward, and I think pretty clean as well. We like clean charts. So here's our flexible grid, and this has everything that I need. I have the big 3 buy and sell signals plotted on the charts. I've got my big 3 squeeze, got my custom momentum histogram. I have my multi-timeframe signal labels, and then I have my multi-timeframe labels for the squeezes. So as far as the buy and the sell signals, when we have a green label, or a green bar or a green arrow, that means all of our bullish criteria is met. Right? That's the big 3 buy signal. So on the weekly, the daily, the 4-hour, 2-hour, 1-hour, and the 5-minute, with those labels all being green, that means we have an active buy signal. The gray bar means things are neutral. Not bullish, not bearish, just neutral. And then a red label, or a red bar, red arrow, that's our sell signal. And that means all of our bearish criteria has lined up. So these labels here, they coincide with the arrows that are plotted on the charts. So my favorite trade being the squeeze, incorporating the buy signals or the sell signals with the squeeze makes my job of catching these explosive moves that much easier. The squeeze gives me compression. During the squeeze, if the indicator prints our buy signal, that tells us momentum, structure, the moving averages, everything is aligned for a push higher out of that squeeze. Okay, how to use the big 3 squeeze. And remember, a squeeze just tells us that the stock is gearing up for what could be an explosive move. From there, we have to call for timing and direction. We got to figure out when should the squeeze fire, and then we have to figure out the path of least resistance. Should the squeeze fire to the upside or to the downside? So that's where the big 3 buy and the sell signals play a really big role. Based on my momentum criteria, my structure criteria, and a few other things, these tell us whether or not the path of least resistance is to the upside or to the downside. So the green labels, which coincide with the green bar and the green arrow, that's your big 3 buy signal. And the red labels, which of course coincide with the red bar and the red arrow, that's your big 3 sell signal. So what I learned was once we have a squeeze, and then during that squeeze, during that compression phase, if the indicator prints a buy or a sell signal, now we can call for timing and direction. So in the example of Mara here, the squeeze is printing. We get the green bar, the green arrow. So now during the squeeze, momentum, structure, everything's fully aligned for that squeeze to fire to the upside. So a few different things here on the big three squeeze. We have the momentum histogram, we have the squeeze arrows, and then we got a couple of labels here, which I think do a really good job of automating the process. And then a quick side-by-side comparison of the original squeeze and the big three squeeze. So the first thing here is the momentum histogram. If the histogram is blue and above the zero line, that means momentum is bullish. So the bulls have got the wind at their back. If momentum is below the zero line in red, that means momentum is bearish. And then we have the squeeze dots. So on the big three squeeze, the blue dot, it means we have an active squeeze. So the stock is going through that compression phase, and then when we get the gray dot, it means the squeeze is either fired, so we're going through the expansion phase, or there's just no squeeze at all. And worth noting, the big three squeeze, it uses a custom compression setting. To me, this helps find the sweet spot squeeze. We're not going to find them too early, but we're not going to find them too late. Kind of catching them right there at that sweet spot. And then we have the squeeze arrows. So my favorite trade, if I'm looking to get long, is a combination of an active squeeze and an active big three buy signal. So down in the squeeze histogram, you have your green arrows or your red arrows. If the green arrow is printing, you have what I would call the bull squeeze. An active squeeze and an active buy signal. The opposite would be the red arrow, and that's your active squeeze with an active sell signal. And then the labels here, these pretty much put the whole process on autopilot. We have a label for A+ setups. So if everything's coming together for the perfect long, that label will be green. Vice versa for a short. We have labels for our upside and our downside targets. We have the target hit label, and then we have the bull score and the bear score. So what is an A+ setup? And whether I'm swing trading on a weekly chart or a daily chart, whether I'm day trading on a 30-minute or a 15-minute, the only thing I'm looking to trade is this A+ setup. An A+ setup is a combination of an active squeeze, an active big three buy or sell signal, and an entry right there in that buy zone. So now I have my moment in time, and trading that moment in time with an entry in that buy zone allows me to work that trade with a really good risk versus reward. Okay, daily trading disciplines. So one thing that I'm really a firm believer in is you want to become a specialist. In other words, you don't want to be a jack of all trades. You want to find that one setup, using I think maybe one or two indicators, and then live it, breathe it, and try to master it. All right, make that your go-to setup. And then on a daily basis, you want to focus on nothing but that A+ setup. So when it comes to scanning, when it comes to building your watch list, whether you're looking to get long or short, whether it be a day trade market or a swing trade market, you want your entire focus to be on that one setup, which for me, of course, is the big three squeeze. My second piece of advice with your go-to setups would be to keep a trading journal for every trade that you take. Or if you can archive every trade you take on a daily, weekly, monthly, and a yearly basis, imagine about 100 trades from now, you've built up a really good archive of all of your work. This allows you to look back and see what's working well, what are some things that aren't working well, and more importantly, where can I make progress, where can I make some improvements to become a better trader with that given setup. Alright, so a few things here as a conclusion. First thing being, traders need a well-defined strategy that includes a few different things. One being a clear entry, oftentimes based on a technical setup, or it could be based on fundamental analysis, all while working on good timing. All right, find your go-to setup. Try to lock in those entries that will give you a really good risk versus reward. And then as far as exiting trades, that's always going to require discipline. And I think exiting your trades and making those business decisions to ensure you're protecting your account, it's so much easier when your exits are based on a predefined game plan. Meaning you don't want to open a trade and then during the heat of battle, figure out where you want to close that trade. All right, everything should be determined, everything should be laid out before you actually pull the trigger, getting long or getting short. And then the third thing would be, of course, the squeeze. I've built my entire trading career around the squeeze. I'm a firm believer you can do that as well. Day trading, swing trading, bigger time frames, larger time frames, as far as where the squeeze can be used, it really is universal. The equities market, the options market, the futures market, I'm a firm believer if you make the squeeze your foundation, you can build a trading career from there.